Gabriel Wallach is in the camp of investors bullish on stocks. He manages $2.5 billion as part of the team of global emerging market equities at Fortis Investments, and joins us on the show today. Gabriel, welcome to the show. There's some, I've run into more and more doubting Thomases who said that, all the buzz and all the glowing attributes paid to emerging markets might get tarnished a little bit this year, with a lot of bombed out markets becoming more attractive. What do you think? Concur or non-concur?
No. Well, first of all, good morning, and thank you for having me. We continue to be generally constructive on the markets. Similar themes to last year: the cyclical markets, technology, consumer, the resources continue to be interesting, and the leading markets such as Brazil, Russia, and China, actually, despite recent concerns, continue to be attractive in our point of view.
What are the let's take the opposite tack for a second here. What's the biggest question mark in your mind? What is the big thing or the barrier that keeps you from throwing all the money at your disposal into stocks in emerging markets? There must be a balancing counter. There must be a counterbalance to this.
No, absolutely. Last year's returns, first of all, were very large, led by a recovery in credit and earnings. So the emerging markets benchmark was up about 78%. So certainly the recovery's been very strong. And as seen this week by China, the stimulus, either through interest rates or through government spending, has already occurred and will be probably reversed sometime in 2010. In the case of some markets, maybe earlier than expected.
What's your defense against inflation? Do you have a plan in place, a plan B?
Well, our sector allocation continues to be positive on resources, and that's one way, certainly, that one can hedge some pickup in inflation. Resource companies continue to have pricing power. In addition to that, some consumer staple companies also continue to have some pricing power in markets, particularly like China. So inflationary pressures will be there this year, given the low rates of inflation in 2009. So we're slightly less concerned. But companies with pricing power in technology, in consumer staples, in resources, will continue to benefit from the recovery and growth, which is actually the reason why we're seeing inflation return to the markets.
Okay, so your thematic positives there are durability of the consumer, enablement through technology, and stuff. Resources. What's on the flip side of the equation? What is a positively lousy bet for this year?
Well, the competition in certain sectors, such as telecom, particularly in Asia, has been a problem for companies. Even the large franchises in the larger markets have faced heavy competition, deregulation, pressures on margins. So the telecom sector in 2009 has clearly suffered from those pressures, and that's one of the reasons why it's underperformed so much. Also, the utility sector has been pressured by higher resource prices, such as coal prices. Coal companies have performed very well, but on the other side, the buyer of coal, mainly the electric companies, have not done as well. Definitely, the sector allocation is very important in emerging markets. It's not going to be as easy in 2010, simply buying bombed-out credit plays or cyclical stocks. But the reason for higher inflation, the reason for concerns on higher interest rates, is coming from a better growth outlook.